Some big numbers coming out of the housing market today, and they're not looking pretty if you're looking to buy or rent.
There's a bidding war for literally every home on the market, every fixer-upper, every house that needs even a lot of work.
Our house had 44 offers on it.
The deurbanization trend, that's a real thing. People are moving out of the city, they're buying bigger houses.
I think the way the suburbs were built was a big mistake. They should have been built very differently.
Home prices in the large urban metropolitan areas were so expensive that people started moving out.
Rent growth has accelerated coast to coast, in big cities, east, west, south, north, just across the entire economy.
How hot is it? It's turning cold. Existing home sales falling in March, but at least in part because there just aren't enough homes to buy.
Imagine a life where you're trapped in a never-ending cycle, struggling to break free from the shackles of debt, where your dreams of financial freedom remain just that, dreams. It's a reality that countless individuals find themselves unknowingly caught in a web that keeps them poor forever. It's time to uncover the truth behind one of the most insidious financial instruments of our time, the mortgage. How and why are mortgages making us poor? And the solutions are also explained here in this video. Stay tuned. A mortgage is a loan that is secured by a property. The borrower agrees to make monthly payments to the lender over a period of time, typically 15 or 30 years. At the end of the loan term, the borrower owns the property outright. Mortgages are a popular way to finance homeownership. They allow people to buy a home without having to save up the entire purchase price up front. However, mortgages also have some drawbacks. The biggest drawback is that they require borrowers to pay a lot of interest over the life of a loan. There are two main classifications of mortgages. One is a fixed-rate mortgage, and the other one is adjustable rate mortgage, or ARM. Fixed-rate mortgages have an interest rate that stays the same for the life of the loan. ARMs have an interest rate that can change over time, typically based on an index such as the LIBOR rate. When you take out a mortgage, you'll need to make a down payment. The down payment is an amount of money that you will pay up front, and it will reduce the amount of money that you need to borrow. The amount of your down payment will affect the interest rate that you are offered. Mortgages are a long-term financial commitment, and they can be a major drain on income. The interest payments on a mortgage can be significant, and they can take up a large portion of your monthly budget. This can make it difficult to save money for other financial goals, such as retirement or college. In addition to those high interest rates, mortgages also have other hidden costs, such as closing costs, appraisal fees, and property taxes. These costs can become up to the thousands of dollars, and they can make it even more difficult for borrowers to bear their monthly payments. If you cannot afford your mortgage payment, you may face foreclosure. Foreclosure can have a really harmful impact on your financial health, and it can make it difficult to qualify for future loans. As a result of these high costs, mortgages can keep people poor forever. They trap borrowers in a tedious cycle of debt, and they make it difficult to save money for other financial goals, such as retirement or college. There are several ways that mortgages can keep you poor. First, they require you to pay a lot of interest over the life of a loan. The interest is essentially a tax on your home ownership, and it can take a big bite out of your income. For example, let's say you take out a 30-year mortgage with a 5% interest rate. Over the life of the loan, you'll pay about twice as much as the original loan amount in interest. This means that you'll be paying about $100,000 in interest on a $500,000 mortgage. Second, mortgages are a long-term commitment. If you take out a 30-year mortgage, you'll be making monthly payments for the next 30 years. This means that you'll be tied to your home for a long time, and you'll be less likely to be able to move if your circumstances change. For example, let's say you lose a job and you can no longer afford your mortgage payments. If you sell your home, you'll likely have to pay a lot of money in closing costs and real estate commissions. You may even have to sell your home for less than you owe on it, which will result in a financial loss. Moreover, if you lose your job or experience other financial setbacks, you may be unable to afford your mortgage payments. This could lead to foreclosure, which can have an ugly impact on your credit score and your financial future. Third, mortgages can make it difficult to save money. When you're paying a large monthly mortgage payment, you have less money left over to save for retirement, college, or other financial goals. This can make it harder to build wealth and achieve financial security. For example, let's say you have a $500,000 mortgage with a monthly payment of $2,500. If you also have other monthly expenses such as car payments, student loans, and credit card debt, you may only have a few $100s left over each month to save. This can make it harder to save for retirement or college, especially if you have a low income. If you're thinking about buying a home, there are a few things you can do to avoid the mortgage trap. First, you should make sure that you can afford the monthly payments. This is the most important factor in avoiding the mortgage trap. You should not take out a mortgage that you cannot afford. Even if you think you can make the payments now, things can change and you could end up in a situation where you can no longer afford your payments. You should also consider a shorter-term mortgage, such as a 15-year mortgage, which will lower your interest rate. Interest rates can vary from lender to lender, so it's important to shop around and compare rates before you choose a mortgage. You can use online tools or talk to a mortgage broker to compare rates. You could compare rates from different lenders using online tools or by talking to a mortgage broker. A shorter-term mortgage will have higher monthly payments, but you will pay only less interest over the life of a loan. If you can keep up with the higher monthly payments, a shorter-term mortgage can save you money in the long run. Finally, you should be aware of the hidden cost of homeownership. These costs can add up, so it's important to factor them into your budget. Along with the monthly mortgage payment, there are other costs. These could be associated with homeownership, such as property taxes, homeowners insurance, and maintenance. These costs can add up, so it's important to factor them into your budget. Before you buy a home, you should have a plan for your finances. This includes having a budget and saving money for emergencies. If you have a plan, you'll be less likely to get into financial trouble if something unexpected happens. Now, let's go through some previous lessons on mortgages. The subprime mortgage crisis of 2008. The subprime mortgage crisis was a financial crisis that began in the United States in 2007 and lasted until 2009. It was caused by a number of factors, including a lax lending standards, low interest rates, and an increase in the demand for subprime mortgages. Subprime mortgages are loans that are given to borrowers with poor credit histories. When the housing market collapsed in 2007, many subprime borrowers were unable to afford their monthly payments. This led to a wave of foreclosures, which had a ripple effect throughout the economy. The housing bubble in California in the early 2000s. The housing bubble in California was a period of rapid increase in home prices in the state. This bubble was caused by a number of factors, including low interest rates, an influx of foreign investments, and speculation. When the bubble burst in 2007, many homeowners in California were underwater, meaning that they owed more on their mortgages than their homes were worth. This made it uneasy for them to sell their homes or refinance their mortgages, which led to many people becoming poor. The housing bubble in Florida in the 2000s. The housing bubble in Florida was similar to the one in California. It was caused by a number of factors, including low interest rates, an influx of foreign investment, and speculation. When the bubble burst in 2007, many homeowners in Florida were underwater, meaning that they owed more on their mortgage than the worth of their homes. This made it difficult for them to sell their homes, which led to many people becoming poor. The mortgage crisis in Ireland in 2008. The mortgage crisis in Ireland was caused by a combination of factors, including low interest rates, lax lending standards, and a housing bubble. When the housing bubble burst in 2007, many homeowners in Ireland were underwater, meaning that they owed more in their mortgages than their homes were worth. This made it difficult for them to sell their homes or refinance their mortgages, which led to many people becoming poor. In addition to these specific instances, there are also many people who become poor due to mortgages in more general ways. Mortgages can be a good way to finance home ownership, but they can also be a financial trap. If you're thinking about buying a home, it's important to understand the risks involved and to make sure that you can afford the monthly payments. By following these steps, you can avoid the mortgage trap and build financial security for the future. Hope this video was helpful for you. And if it was, give the video a big thumbs up. Also, don't forget to comment down with your queries and other comments. We'll see you again soon. Till then, bye.